Bitcoin will be the liquidity sponge. Bitcoin will go to the moon. Guys, I cannot even begin to explain to you. If they inject all this liquidity, they send rates to zero, and we go through, we're on the brink of a sovereign debt crisis in the United States of America, and they need growth. So growth is another way of they're going to bet on the economy, which is another way of they're going to print a bunch of money and pray that inflation doesn't get them to lose the election. Bitcoin and stablecoins are the liquidity sponge. They're the best expression of currency debasement. They're going to soak up all the printing. They're going to soak up all the liquidity. Bitcoin's going to 250 to a million this cycle. That is still my prediction. I don't let the dumps phase me. You can't phase me.
The US dollar has long reigned supreme, serving as the de facto unit of account, the core of global payments, and the premier store of value and reserve asset. But Jack Mallers warns these pillars are showing signs of fatigue. While China stepping back from U.S. Treasury purchases sparked headlines, Mallers asserts that the problem is broader, even systemic. The U.S. has become a drunken friend, drowning in roughly $37 trillion of debt, and the well of willing creditors is running dry.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Is the dollar the de facto unit of account? Are things priced in dollars primarily? Yes. Is the dollar the de facto payments network? Is the dollar the most popular payments network in the world? Yes. Is the dollar the premier store of value? The premier reserve asset? No. No. Guys, that's a huge deal. This is a massive development. Okay, China stopped adding on net bonds and treasuries, some time ago, but that's just China and they hate us. No, it's not. It is everybody. And we've talked about on this show, the US has really, really struggled to find the marginal lender. Again, buying a treasury bond is effectively lending to the US government and getting interest in return. The United States has found it extremely difficult to find someone to finance their future, to lend them money. They are the drunken friend, $37 trillion in debt. And the gig is up. And the fact that gold is the replacement, again, goes to show the future of the world we are heading towards. And if you think Bitcoin's not going to be a critical part of that world, I don't know what to tell you. Have fun staying poor. People are always like, why is Bitcoin falling? Why is Bitcoin falling? I thought you said it was perfect. For me, Bitcoin is the best expression of currency debasement. It's the best index on global liquidity. If the world is feeling a bit uneasy, Bitcoin is going to fall because it is risk on, risk off. If risk comes off, Bitcoin's going to feel that. Conversely, Bitcoin will rise just as violently to the upside. I personally think Bitcoin is leading the stock market right now. If these looms continue, if things continue to be tight, I expect stocks to get hammered as well. Bitcoin typically leads. Gold setting new all-time highs. I already know where Bitcoin's going. It's a matter of months. It's not worrisome, guys. So for those of you that are sweating over the price, you got to stay humble. You got to stack sats. You got to lower your time preference. The price should not bother you. And what I think is happening is there's so much uncertainty globally. I mean, we're talking about massive capital flows. A relationship like the US to India, that's a huge, huge deal. And I think Bitcoin is smelling a little bit of uncertainty. It's smelling a little bit of blood. It's leading the stock market. And unless things, Trump typically chickens out, right? We don't know how these are going to resolve. And if they do, Bitcoin's going to whipsaw up to the upside so fast, you can't even blink you're going to miss it. You're going to miss it if you blink. If you wanted to get a real argument, like what are our great-great-grandkids going to be reading in history? It started in 2008. It started when Satoshi Nakamoto released the white paper on the back half of the global financial crisis where the United States said, fuck you. We get to print money out of thin air. We decide who controls time and energy in this world, not the free market. That's when it started. And you can look at these charts. You can see we are in a new era. Get yourself hard money. Get yourself neutral reserve assets. You do not want a liability with the US government. You do not want a liability with a company. You want to save your money, that something that protects you so strongly as the laws of Mother Nature. Get yourself some proof of work. Get yourself some proof of work. Stable coins are now strategically valuable to the United States of America. There is no ifs, ands, or buts about it. We speak facts here on this show, especially after the Genius Act. What have we been talking about? We say stable coins are the ace in the hand for the United States. They're a way to get marginal lenders to the country because every single stablecoin minted is a U.S. Treasury buyer. They are T-bill purchasers. So if you want more lenders to the U.S., grow stablecoins. What's the best way to grow stablecoins is to grow Bitcoin, and vice versa. When stablecoins grow, Bitcoin grows. When Bitcoin grows, stablecoins grow. They are the most liquid trading pair in the future world reserve currency. Bitcoin and stablecoins are the liquidity sponge. They're the best expression of currency debasement. They're going to soak up all the printing. They're going to soak up all the liquidity. Bitcoin's going to 250 to a million this cycle. That is still my prediction. I don't let the dumps phase me. You can't phase me. This is their political scapegoat. Housing crisis caused by the Democrats, but make no mistake, they are sending rates as close to zero as they possibly can. They will then use stablecoins with those near zero rates to have an unbounded lender to the United States government. And they are going to focus on markets like real estate. Bitcoin will be the liquidity sponge. Bitcoin will go to the moon. Guys, I cannot even begin to explain to you. If they inject all this liquidity, they send rates to zero, and we go through, we're on the brink of a sovereign debt crisis in the United States of America, and they need growth. So growth is another way of they're going to bet on the economy, which is another way of they're going to print a bunch of money and pray that inflation doesn't get them to lose the election. That's what we're going to live through. Plain as day, fiscal dominance. Say it with me now, fiscal dominance. That's what we're in. Rates have to come down. Doesn't matter what the Fed says anymore. In fact, if you're part of the Fed committee and you disagree, you're fired. They're going to find something illegal you did and fire you.
Mallers spots early signs. Members of the administration, including the president, reportedly holding Bitcoin, discussions about opening retirement markets to crypto investments. These are strategic moves to refrain opposition. Bitcoin holders benefit from debasement too. Meanwhile, regulatory efforts like the Genius Act signal increasing formal interest in stablecoin infrastructure. Stablecoins may soon be regulated to ensure reserve composition aligns with US the bond.
If the US is going to use stablecoins and Bitcoin as a liquidity sponge, as a way to find marginal lenders to the United States, which we've been talking about, and I know I sound crazy, guys, but I promise you I'm not. First, we'll see that they need oversight over the offshore market. Right now, there is no oversight. You'll start to see some headlines. Trump talks about needing oversight over offshore market for national security, blah, 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 blah. Next, tying the use of central bank dollar swap lines with the Fed and or Treasury to opening up certain aspects of digital markets to U.S. tech firms. Next, regulations put forward to require stablecoin issuers to hold dollars in a U.S. bank branch and or T-bills. Encouragement of stablecoin issuers to list on the U.S. stock market. We saw Circle do that. U.S. big tech firms adding crypto wallets to their social media apps. We've seen Stripe. We've seen SoFi. We're starting to see big tech integrate stablecoins. Keep an eye on this. General positive statements by members of the Trump administration about stablecoins. Okay, so I encourage you guys to read the full article. Sorry I had to read through that, but it's really important. The Eurodollar market is massive. It's $10 to $13 trillion. The problem with the Eurodollar market is not buying T-bills. So what the United States wants to do is get them lending to the government. How do they do that? Stable coins. Without lower rates across the curve, the fiscal path for the U.S. is dire. With lower rates, it is not ideal, but manageable. The question is, can we do it without blowing up inflation? MMT would suggest we can. I think one way or another, we're going to find out. It's a monetary gamble, perhaps a desperate one, but I think that not only the US and the Fed, but eventually the ECB and other major central banks around the world are going to join in on this global experiment of lower for longer, despite inflation staying above 2%. They will pin their hopes on a cocktail of MMT plus AI deflationary forces. Case in point, in 2008, interest expense as a percent of GDP was only 1.7%. In 2020, it was 1.6%, a slight decline. Yet debt to GDP increased from 64% to over 130% in that same period. In 2021, interest expense was down 1.49% of GDP and then doubled to roughly 3%. There's only one way to bring interest expense down as a percent of GDP, less debt or lower rates. So let me just break this down for you guys. What Mel's talking about here, the long and short of it is we drastically increased our debt. So the green line here is the debt. Okay. The blue is federal outlay. So it's interest as percent of GDP. And his point is we drastically increased in the circled part here from 2008 to COVID. We drastically increased the debt, but we were able to kind of hide it because we had such low interest rates. So obviously, if you're paying 0% on debt, who cares? It's not expensive. It's free money. But all of a sudden, when we had to hike rates as fast as we did because of inflation, then banks started to fail and, we're in the mess we're in now. All of a sudden, this becomes very prominent. And you've racked up so much debt that now you have to pay real interest expense on, and it becomes unaffordable. And so his point is you either have to reduce the debt drastically and stop spending, or you have to lower the rates. And we all know what they're going to do. They're going to lower the rate.
Mallers isolates key data. Before COVID, the U.S. bore massively rising debt, but low interest rates allowed it to float, paying minimal interest expense relative to GDP. When rates spiked, the system faltered, banks failed, and expense skyrocketed. His point, the federal government must either drastically cut debt, politically nearly impossible, or bring interest rates down. The market logic says they'll choose the latter.